Thanks for tuning into BQ Conversations. I'm your host, Neeraj Shah. Pranjul Bhandari of HSBC and her colleagues have written a note which is titled India's Growth Exuberance and the Role of Commodity Prices, wherein they say, and I quote, that economic activity in India has been surprisingly robust, and they believe that lower commodity prices are at the heart of all of this. Let's get her in on this show to try and understand what has stood out for her in terms of India's economic activity and what is her hypothesis about how long and how far can this last. Pranjul, great having you. Thanks for taking the time out.
Great to be here. Thank you for having me.
The pleasure is ours. So I love the term exuberance. I love the term surprisingly robust. What has stood out for you when you look at these data points?
Look, we get a lot of data that flows into India, and all the data I'm tracking, on manufacturing, on certain imports, on some specific exports, particularly high-tech exports, on tax collections, on government capex. All of these have remained quite resilient, and I would say surprisingly robust over the last couple of months. And my sense is that what's really happening in the Indian economy and what's at the center of all of this is the joy of commodity prices falling. The fact that across the board, commodity prices have fallen by 25 to 75%, be it oil, be it metals, be it some food prices. I think that has been very positive for India. Just, one small sensitivity. For every $10 a barrel fall in oil prices, growth rises by 20 basis points. And to the extent, oil prices have fallen by about $20 a barrel in the last year from 100 to 80, that on its own adds 40 basis points to India's GDP growth. So there's been a lot of exuberance coming out of this. And, I'm happy to sort of talk more about how we are seeing this in things like corporate margins and consumer spending.
Okay. So just before I get to that, a point about the term that it's surprisingly robust. It is surprising because normally in a scenario like what we may be going through, these growth numbers would not have stayed up so strong.
Well, look, to be very honest, the global backdrop is extremely volatile. As in, the China's reopening hasn't been as strong as one would have liked. We are seeing certain ASEAN economies also, having slightly lower growth. There's mixed signals from many of the advanced economies. So my sense is that at a time when global trade seems to be quite weak and quite uncertain, it's sort of counterintuitive that India's GDP growth remains so robust.
So would it be attributed largely or almost entirely to this commodity price factor, or could that, coupled with this whole factor of companies wanting to set up shop in India, a lot of sectors which were hitherto not present, electronics, maybe the whole spend that is happening around railways and the continuation, I presume, of the real estate cycle also play a part of sorts?
Well, there are lots of factors. And in a way, I'm going to condense what you're saying into two things. One is cyclical and the other is structural. Mm-hmm. I think when we talk about, global growth going up and down and therefore commodity prices going up and down, we're talking about cycles, and that's more cyclical. And that's the cyclical benefit India has been enjoying for the last couple of months. And I think that really explains the recent exuberance that we've seen. But what coexists with this cyclical positivity is also a lot of structural changes, that are happening, as in India's high-tech sectors, both high-tech manufacturing of goods as well as the export of services are rising. There are a lot of structural gains coming out of India's public digital infrastructure in terms of a structural improvement in bank credit growth and, many other things. And I think all of that talks about a medium-term higher GDP growth in India. So there's a positive cyclical element and there's a positive structural element. And I think at this point, both are coexisting. But I would say that the recent data that I was talking about in terms of manufacturing, in terms of tax growth, all of that I will attribute much more to some of the cyclical factors because they have come completely in line with the fall in commodity prices.
Got it. So I was going to ask you that to the extent that it's possible to extrapolate, is it possible to predict what will last? But I presume that if it's happening largely due to cyclical factors, it's almost difficult. It's almost impossible, if not, totally impossible to predict that.
Yes, that's right. And I would say that there are a few risks in the horizon, at least for the cyclical growth. One is the commodity prices itself. It's great they've fallen, but you pretty much just need some good news on global growth and it can start going back up again. So we have to be careful about that. That's not permanent. And then there is El Nino, and I think we should come back to that because it's a very special topic. And my own sense is that if it does strengthen over the next couple of weeks, then we could see some slight softening of rural growth. So that's this other risk that we have out there. And a third risk is, look, at the end of the day, if global growth is weakening, it will impact India. And I think one important channel is services exports, because that's where we saw huge growth last year. We saw the entire face of services exports rise. It was not just your IT majors, but it was professional services, MNCs putting up captive service centers into India. But if global growth weakens, that will also slow a little bit. So I think these are some of the risks in the horizon that we can't avoid at this point.
Okay. And I'll talk about El Nino, also the point about corporate margins as well. But just one quick question before that. What is the house view on what happens to global growth? Because the opinion around what happens in US is split. We know that China is a bit of a black box. And Europe, for some people, has been surprisingly strong relative to what they had anticipated. So how are you penciling the global growth factor when you think about what could happen to India?
Yeah, look, we expect it to remain quite sluggish, for the next couple of quarters before it bottoms out and it starts to rise. Of course, China has been weaker than was anticipated earlier in this year. US, at least parts of US, particularly its labor markets, have been surprisingly resilient. Some data points in Europe and in Asia have sort of held on. We are seeing commodity prices fall, and that could lower some parts of inflation. But other parts of inflation, for instance, services inflation, continues to remain rigid. And therefore, central bank rate cuts may not come in a huge hurry, at least may not come in this calendar year. We sort of have the first Fed rate cut only in the second quarter of next year. So to that extent, I think global growth will remain uncertain and on the weaker front this calendar year.
Okay. What about El Nino? I'm reading your note which says the trade-off is too good to be true, or maybe you're asking that question. Tell us about this.
Yeah, look, generally speaking, El Nino has been associated with weak rains and therefore high food inflation and low growth, right? Low rural growth. My sense is that this relationship has changed a bit over the last decade. What we find right now is that food prices don't react that much to El Nino. They can remain fairly range bound despite an El Nino strengthening. And the reason are manifold. I think one is that for certain food items like pulses and oil seeds that India tends to import when it has a shortfall, global prices have fallen. So imports can be very useful. Then if we look at our own rains and reservoir levels, they look very strong for the Northwest, which is the backbone of India's food security. So I think that should be, some sort of positivity. And then the most important thing is generally what we see in terms of the government's supply management steps has been extremely strong over the last decade, and we've seen a structural fall in food inflation, ranging from cracking down on hoarders to importing, exporting, buying, selling very quickly. So my sense is it's going to be tricky. Like, for example, the tomato price rise right now, which hopefully will fall by September. So there'll be lots of ups and downs. But on the whole, if you take an average of 3 to 4 months, I think we will be able to keep a lid on inflation. But that creates, but there's another problem, which is what happens to rural growth. To the extent we are taking care of food inflation by importing a lot of things, it means that our farmers are not enjoying, that surplus. We're not buying it domestically from our farmers. And I think that's, again, one more thing we've seen over the last 10 years, that real rural wages have actually been softening. And my sense is if this year the El Nino does strengthen, we could again see the same thing, of rural incomes being a little challenged.
Okay. But Pranjul, just a question there. Maybe it's just a 12-month phenomenon, but would the rural balance sheet over the next 12 months have a higher proportion of non-farm income, infra, so on and so forth?
Yeah, look, that's a great question because the proportion of construction in the rural balance sheet has actually been rising, while the proportion of agricultural activity has actually been falling. As in, this is something we've been seeing over the last 2 decades. And in a way, this provides some stability. The fact that, look, if India's whole real estate market remains strong, a lot of rural Indians can actually go and work in construction and send remittances back to rural India. And we've actually seen that we track data on remittances from urban to rural India, and that has been rising. So this could provide some cushion. The other thing that could provide some cushion is the general fall in rural inflation. If rural inflation falls, purchasing power rises and people can actually, go and buy more things. So these two things can provide some cushion. But then, agriculture still remains the most important activity of rural India. So if our El Nino were to come, despite construction being positive, despite inflation, core inflation falling, if agricultural activity is weak, I think at some point it will show up in weaker rural demand. I think the one saving grace we have here is government spending. I do think that there is space in the fiscal math for the year to do some extra social welfare spending for rural India. In a way, that is sort of a silver lining, and basically the government will just have to be very nimble and keep a close eye on the situation.
Is this on the back of an assumption of higher tax income for the government, or based on the math laid out by the government in the budget itself, Pranjal?
Well, it's a combination of things. One, you're right. I think tax revenues have been surprisingly good, both direct and indirect. So that helps. But then there's also been the RBI dividend, which the central bank gave to the government, which was higher than expected. And then there is another part, which is CapEx. Earlier this year, when the government announced its CapEx plan, it was 10 trillion rupees. Last year had been 7.5 trillion rupees. It's very difficult to scale up CapEx spend so much in one particular year. There are implementation bottlenecks on the ground. My sense is they'll be able to scale it up, but not all the way to 10, probably from 7.5 to 9 trillion. And then that will again leave some space, some money out there for any new scheme that the government may want to announce or, restart if there is rural distress.
Okay, got it. Thanks for that, Pranjal. Now, I'm going back to the first or the second answer that you gave, wherein you mentioned that it'll be worthwhile to talk about the impact of this kind of growth on corporate margins as well as rural spending. Is that what you said? And I would love to understand how you therefore hypothesize about both of these.
Yeah, look, I wanted to really talk about the fall in commodity prices and the channels through which it makes growth look much better and growth sort of rises. One is the fact that on corporate margins, the fact that input prices for many of these firms are falling. But if you look closely, they're not really cutting output prices, which basically means that their margins are rising, and margins were very weak last year and they've really risen this year. And it's not just the large firms. We also track small firms, mid-size and small firms. And this is across the board. So corporates across the board are seeing much better corporate margins this year than they were seeing last year, thanks to the fall in commodity prices. Now, some firms out of this, especially the large firms, are also using this space to increase wages and salaries to its employees. And to the extent some employees are getting higher wages and salaries, they're actually going out there and buying more things. Also, to the extent core inflation is falling, the purchasing power of consumers are also rising. And we're seeing this in the fact that consumer imports have increased in the last month or two. We're seeing consumer durables production has increased in the last month or two. So that's the second benefit. And then the third benefit is if your manufacturing is good, if your consumption is good, activity is good, then taxes rise. And both the central and the state governments have been seeing, strong tax growth. And that has made its way to CapEx. We are seeing public sector CapEx, both by the central government and also by the state government over the last couple of months. So these are all the different channels via which lower commodity prices are really helping India's, GDP growth at this point.
Got it. And therefore, one would suspect that corporates which are largely exposed to the B2G or corporates which do work for the corporates that are exposed to B2G per se would probably be the key beneficiaries, because we're not quite seeing private capex really come up to the fore. Would that be a fair assumption?
I think so. I think so. I think that's right. We have a situation in which public capex, which makes up 20% of India's investments, are the ones which are doing well. Private capex hasn't really joined in a big way. Of course, there are some small green areas, like, for example, some futuristic sectors and all of that. But generally speaking, we are not seeing a new private sector capex cycle yet. And a lot of people ask me why. Balance sheets today are cleaner than before. Growth prospects in India seem to be good, which is probably the reason why we are getting all of these equity inflows into the economy. Then why hasn't this translated into a private sector capex? And my answer is that, look, private sector capex rarely flourishes at a time of macroeconomic uncertainty, at a time when commodity prices are volatile, inflation is hard to predict, cyclical growth, particularly global growth, is hard to predict. In this kind of a scenario, nobody wants to put money in the table for the next 3 to 5 years. And, capex has large cycles. So, hopefully later in this year, when the macro environment stabilizes, inflation globally falls more surely, we're thinking about central bank cutting rates. I think at that point, we could see private capex rise back up, but we really need the macro environment to stabilize.
A bit of an unpredictable scenario, but which would mean, Pranjul, that your thesis would be that we're not seeing the advent of private capex at least until second half of 2024. Sorry, I don't want to put words in your mouth. Just trying to guesstimate.
Yeah. Look, I'm hoping that we'll start seeing some signs of it in the first half of 2024.
Okay.
Which is around the time when we're also expecting the first Fed rate cut. And I'm, in my forecasts, we're expecting some light rate cuts by the RBI as well. I think around, and that would be triggered by the fact that the inflation problem is to some extent in control, which is letting the central bank cut rates. I think that would basically mean that the macro environment has stabilized.
Got it. Pranjul, last one question or two if you have the time. I was seeing some of the charts that you put out in the note. One of them was about the high-tech good exports, which are on the rise even as the low-tech goods have come off. Now, when you wrap your head around this, is this more a sign of what happens? Because India traditionally has been an exporter of great services, but low-tech goods. It's probably for the first time that you might also be seeing data like this. Is this more a trending event, or is it difficult to say?
Well, look, actually, if you look carefully, then the proportion of high tech in India's exports has been rising over the last 2 decades from, less than 50% of overall exports to currently around 70% of overall exports.
Okay.
Especially with the advent of services. You see, I'm also counting services into this.
Yeah.
So as you add up services exports, which have grown 33% last year. It was incredible growth. And then you add to that some of the exports of high-tech manufactured goods, electronics, mobile phones, drugs and pharma, auto parts, some specialized machinery and chemicals. That is the part that is really growing. And I think that will continue over the next 5 to 6 years. I'm going to just take a second to say something special about services exports. We in Asia know a lot about going up the value chain for manufacturing because most Asian economies have grown that way. So I thought, let me look at something else, going up the value chain in services. There are many countries like US, UK, Ireland, Singapore who've gone up the value chain in services. And when you look at their experience, once you reach a critical minimum of global market share, after that, you see very rapid growth. You create scale, you become far more efficient, and then you start growing even more faster. And my sense is India is at that tipping point, after which many other countries like Ireland, Belgium, UK started to grow even faster in terms of the growth of their services exports. So I feel very positive about that part of India's exports and the contribution of that to India's GDP. And then there's, of course, high-tech manufacturing, but it's very narrowly defined right now. It's mostly mobile phones, some other electronics, drugs and pharma, auto. My hope is that others pick up too. But at this point, it is sort of focused in a few sectors.
Pranjul, I'm going to go off the subject of the report, but that's my final question to you. Nothing out of the ordinary, but for a lot of people, India is at the position wherein the pivot from 3.5 to a higher number becomes rapid because there is a base. On the per capita GDP as well, at levels from where the uptick can be pretty swift because you break a threshold. That's what some hypothesis is. I hear you telling me that on a services side as well, we are now at a level from where the uptick could be rapid. Safe to assume that if everything goes as per plan, then we are looking at a fairly strong growth period for services, and through that, everything else as well for the next 3 to 5 to 7 years?
Yeah, I would think so. Look, I'm going to, again, this is structural growth, right? Structural growth means like you sort of look through the current noise and you look, to a more like a 3 to 5 year horizon. So of course, there's a global growth slowdown going on right now. So that, temporarily there could be some problem, but in the 3 to 5 year horizon, yes, I agree with you. And I think it'll be led mostly by the high tech sectors, both high tech goods exports, as well as services exports. And then, the startups who have plugged into the public digital infrastructure, they've also gone through their own period of consolidation. Probably they'll come back stronger. And I think a combination of all of this, which I call New India, I think can raise India's potential growth. As on the eve of the pandemic, our growth was around 6%. My sense is over the next 10 years, we could grow by about 6.5%. This is great because on the back of this, the size of our economy would double, from about $3.5 trillion now to about $7.5 trillion by 2032. Our per capita income will increase from lower middle income to upper middle income. So these are sort of like the good points, but there is one problem. The one problem is that this 6.5% growth may not be enough to create the jobs that India needs. And in a way, the high-tech sectors must play a role in lifting the low-tech sectors. For example, low-tech, mid-tech manufacturing, textiles and all of that, as well as agriculture. If that were to happen, if high-tech can actually energize low-tech via things like agri-tech or digitization of manufacturing, and if the entire economy participates in growth, then I think we solve the jobs problem. But if it's a growth driven by only a few high-tech sectors, we could get that high growth, but it may not be enough to create the jobs. So that's the big challenge for India, to make growth more widespread rather than just, high-tech oriented.
Well, hopefully all things fall into place, Pranjul. But thank you. This was lovely talking to you on a variety of things. Excuse me for not focusing only on the report, but it was just great to get all the pieces out there.
It was a pleasure to talk to you. Quite a freewheeling conversation.
Thanks, Pranjul. And viewers, thanks for tuning into this leg of BQ Conversations.